At this point, I would like to move on to the main focus of our presentation, and with our featured speaker, Robert McWhirter, who is the president of Selective Asset Management Inc. And Robert McWhirter has more than 30 years in the securities industry and is a top-ranked money manager in Canada. And prior to establishing Selective Asset Management Inc., Mr. McWhirter was VP and portfolio manager at RBC Global Investment Management Inc., where he managed approximately $2.25 billion in the Canadian high technology sector of the Royal Bank's Canadian equity mutual funds. He frequently appears on BNN, where he shares his top picks. And today, Robert will be speaking to us about small cap markets. And so, Robert, I'd like to pass things over to you so that you can begin the main focus of our presentation.
Great. Thank you, Jordan, and thank you, Neil and InvestorCube for inviting me to be today's speaker. There we go, we're live. So the portion is not unexpected. Obviously, the market declined significantly, rebounded a lot, was overbought, and basically talked to Javed Mirza. He had a conference call through Canaccord, the technical analyst there, on Monday of this week, and he basically said, look, the jig's almost up, the countdown is moving quite quickly along towards an intermediate correction. So again, it's not unexpected. I hold about 30% cash in my small cap account. And at this point, that's been built up literally over the last 2 weeks in anticipation of pullback provides great buying opportunities. So Javed expects about 10 to 15% downside in the S&P. I didn't see where we closed today, but certainly it was a 4 to 5% haircut across the markets around to 315 this afternoon. But the overall portion is he's still very optimistic in the long term. He sees this secular bull market continuing for 10 more years. Repeat, 10 more years of secular upside on the bull market. Basically, he says, okay, we got this pullback. Overall, he's cautious on commodities, again, for the same kind of 10-year time frame. And this long-term up market, the secular market, is an opinion that's been shared by Leon Tui. Leon in 2008, 2009 said, look, this market's going to go bigger, faster, taller, stronger, longer than anybody could imagine. And he says, effectively, approximately 2 months ago, he said, the pullback that has occurred was the buying opportunity of a generation. Again, we're having a pullback and we're overbought. So Lowry Research put out a piece this morning that said, from yesterday's note, the S&P was extended and a whole bunch of overbought conditions, but they reflect an extremely strong demand environment, which is not typical of deep corrections. So again, 10 to 15% haircut. Obviously, some stocks will go more than that. Mark Garrett, who's the quantitative technical analyst at Cormark, put out a piece this afternoon saying, okay, we got really close to actually getting the all clear signal for the markets to continue upwards. RSI hit 59, but RSI did not hit 60. As a result, he's suggesting that from the 31 to 61 levels, where around 3 o'clock today, there was a further kind of downside support levels of 5.7, minus 10%, or minus 15%. So again, pullbacks but opportunities. All right, let's move to the next one. I focus on my business as a barbell. We'll talk later on about the Canadian conservative growth strategy. But the fun part is the kind of small cap stocks. On December 16th, I did a presentation in front of Ellen Roseman, who used to be the financial reporter at the Toronto Star. Basically picked 7 stocks, including a couple of stocks we'll talk about today, including Cielo. 5 of those 7 stocks did well. Cielo did not. It was one of the duds. But fortunately, the 5 of the 7 stocks on average were up 35% year to date. One of those stocks was Cemetrix. We talked about it. It's a puppy cement contract or company. I talked about it on BNN. That was one of my top picks. And what I'm finding is a lot of these companies are kind of hidden gems, and you really have to kind of work hard to convince the analysts and the street to kind of take advantage. So as an example, ZBEC, XEBEC, symbol X-ray Bob Charlie. I talked about it on BNN back about 18 months ago. I bought the first stock in some of my accounts at around 74 cents and literally sold it about a week ago for about a 5.3x return. In part, the reason was, okay, when it was one of the 7 stocks recommended with the kind of end-of-year picks, the PE multiples at the time are reasonable. 23 times this year, 13 times next year. The stock having moved from $2.25 at the end of the year to $3.90 about a week ago. The multiples had expanded to 49 times this year and 26 times next year. 26 times next year is still reasonable against a 35% earnings growth. And also remember too that ZBEC is bidding on a backlog, a potential book of business that is literally almost $1 billion. Also remember too that when they do announce contracts, you end up hearing that they've just announced the new garbage dump / landfill contract. That means $15 to $20 million worth of extra revenue on top of what our sales that are expected to be, so a $15 million contract is quite significant. Okay, turning to Cielo Waste Management or Cielo Waste Solutions, this is again a 4-cent stock, has been higher recently. It's about a $15 million enterprise value, trades about 350 to 60,000 shares per day, but again, sometimes trades like a point by appointment. The company's key is that they basically create renewable kerosene from wood fiber, typically sawdust or ground up railroad ties. If you go back into the press releases, you'll see about 4 months ago, they announced a deal with Canadian Pacific to end up saying, okay, instead of shipping the railroad ties down to the US, we can grind them up and process them here in Canada. There's also a similar type of fiber from pulp mill sludge, potential landfills, and PET plastic, which is the kind of big kind of soft drink bottles. The shocking part is that about 96% of all the plastic that you put off to the curb at the end every 2 weeks basically goes, unfortunately, into the landfill. The company recently signed a non-binding memorandum of understanding to sell their renewable kerosene to a refinery that will basically use it to create renewable jet fuel. And unfortunately, the kind of airline industry has a big problem. 1, lack of passengers, and 2, being viewed as a very not friendly environmental kind of consumer of energy. And as a result, I think the kind of renewable jet fuel would be extremely popular. There's the potential on a recurring revenue basis to end up or expanding their plant. That should be back online basically in July. Then they should be able to produce approximately 1,000 liters per hour. That then translates to an annual run rate. If they were able to sell it at $1 for about $8 million, that translates into 1.6 times enterprise value to sales. Potential recurring EBITDA from that after company overhead is about $1.5 million. So that takes you to about a 9 times enterprise value to EBITDA as far as the potential going into 2020. They're also looking at expanding and putting up a second tower at Alderside. And there's also the potential where they end up having 5 other locations where someone will put up the money and they'll end up earning a almost 50% interest with no equity costs from their viewpoint, no debt on their books. They end up getting 50% ownership. So the future of the company, I think, is quite bright. We'll know by probably the end of September as to whether the new process works properly. If so, they'd be able to get loans by the end of the year to be able to expand and do well. I own approximately 2.5 million shares. Jordan, next slide, please. The next company is Earth Alive Clean Technologies. This is not a household name. It's got about a $22.5 million market cap. I originally purchased shares through Desjardins about 6 months ago. And interestingly, the institutional salesperson who serviced me, Matt, basically sent me an email today saying, gee, I've just got an update from Michael Warren, the CEO, and I've talked to him fairly frequently. He notes that the Earth Alive is working with executive management teams. They're making good progress there. So what do they have? Basically a natural microbes that are used to eliminate about 90% of the dust at mining sites, with about a 98% reduction in the water that's used to end up. So currently they effectively have a water truck that buzzes by, lays down water fairly simply, approximately once an hour. Unfortunately, there's a huge cost to the cost of fuel, labor, and maintenance. If we can eliminate those and replace them with the Earth Alive solution, there's significant benefits. The other portion is that there's great concerns as to not only dust, but what will this impact be on traction as well as stopping distance? Oddly enough, compared to dry dirt, stopping distance is actually reduced by 7% a good way. And as importantly, the stuff doesn't freeze up in the wintertime. It works in the winter all the way down to minus 30 degrees Celsius without freezing. And they're currently undergoing tests with large multinational, multi-mine companies. So one of the pieces continuing with the note from Desjardins was that even if mining management doesn't like the idea of using dust suppressant compared to water, unfortunately with restricted staff because of COVID, they're testing the product because they'd much prefer to see the miners hauling ore rather than just driving effectively water trucks around. By working with multiple groups in similar regions, they're able to work fairly well. Each group that they're testing with has 15 to 20 mines. For example, in Mexico, they described their company as testing with approximately 5 kilometers of road, which would produce about $3 million worth of revenue per year. Therefore, if one mining group basically signs up with 3 to 5 sites, as described here, it becomes very interesting very, very quickly. One full adoption will be a potential game changer. So we look at the Q1 sales, most recently $1.25 million, a 6x increase compared to last year. They had a small loss. They've still got lots of cash to be able to cover that loss. We're expecting some deals to be signed between now and the end of the calendar year, quite significant. If you look at the press release, you'll see that they're testing at very large mines in Brazil, Chile, and other locations. There's a potential for recurring revenue of exit 2020 of $17 million, which would put them at a 1.3 times price to sales multiple. On the other side, there's potential recurring EBITDA run rate exit 2020 would be $2.5 million per year. That puts you at about an 8 times price to EBITDA multiple. I own 1.5 million shares, and I have been adding to my position over the last couple of weeks. Next slide, please. Okay, Electrovaya is a company that has been around for a long time. I originally, when I was at Royal Bank Investment Management, did private placements when the company was public, and they make extremely sophisticated lithium-ion polymer batteries. Has a market cap of about $37 million, average trading volume about 120,000 shares per day, and the battery systems are typically used in electric forklift vehicles and other specialized applications. So forklift trucks, I end up saying, geez, they're not very exotic, but the beauty is that the advantage is you're not, as a battery maker, you're not looking for a market. So these guys sold literally lithium-ion batteries to Mercedes for the smart cars. There was never any fire problems, etc. And Mercedes decided over time to end up closing up that project. However, the lithium battery itself offers faster charging, and as importantly, a lower cost per charge over a battery's 7 to 10 year lifetime. And the important part is compared to lead acid batteries, which is the current alternative, you don't have to swap out the lead acid batteries in forklifts, because typically you have one battery that's in the forklift vehicle, you get another one on the charger. When it's charging, it gets really hot, so you have to pull it aside, let it cool off. And then after it's cooled off, then you can put it back into the forklift truck. So you get a whole bunch of people doing that. It's very expensive. You can save a lot of money without that cost. So 50,000 new forklifts sold each year in North America. Toyota's subsidiary, which is Raymond, has about a 50% market share, selling approximately 25,000 new units per year. And basically, it's expected to be, Raymond is expected to be a major growth driver for Electrovaya in fiscal 2021. So if you assume that even if Electrovaya only got 5% of Raymond's business, that would be 1,250 batteries. These things sell for about $30,000 each. That would translate into about $38 million worth of potential sales. So Q2 sales, fiscal Q2 sales were up $2.7 million Canadian. Their backlog is over $14 million. And the company's guidance says sales are expected to approximately double in the coming quarter, which would take you about $5.4 million, and they're expecting EBITDA break even. They've also said that sales are expected to double again in Q4, which would take you approximately $10.8 million, which then gives you about a $43 million annualized run rate, or 0.9 enterprise value to sales. Now remember, the comment was that they would hit break even basically on 5.4 million, with an additional 5.4 million on top of that in Q4. Obviously, it's going to be interesting as to the contribution to the bottom line. On Electrovaya, this is an early start for me. I currently own about 100,000 shares. Okay, on to the next one, please. All right, one of the other pieces that I cover, the portion that allows me to sleep at night, is the Canadian conservative growth strategy. This is a strategy that I used when I was running approximately $60 million worth of money for NextGen for about 5 years, and during that period, it was excellent absolute, relative, and risk-adjusted returns. This is a modification of the strategy that I used there. It has been enhanced significantly. It basically focuses on up to 15 stocks. And if it turns out that the strategy is run every night, the portfolio is rebalanced at the end of each month. And if it turns out that there aren't enough stocks to qualify, then we'll quite happily move to cash. There are 3 different stop loss portions that are built into the strategy itself. During the month of March, we held, at that point, from recollection, we were down to 11 stocks compared to 15. In April, we went back up again. You'll see the list of stocks there. You can see 2 precious metal stocks, both in Barrick and in Franco, Nevada. I talked about it on BNN that we had purchased Barrick and Franco. Again, the model, because it has a big focus on cash flow, basically looked at those 2 companies and said, look, the price of gold's gone up. One of the biggest expenses, diesel fuel's gone down. The companies are making decent money. And overall, if you look at the kind of targets that Javed, Mirza, and others have for gold, you can end up seeing that Javed has basically a target of 1775. If it gets above that, then he sees 35% upside to 2400. Mark Derriott at Cormark suggests that his point and figure work on gold suggests 51% upside to 2650 and possibly as high as $3,000 US, which would give you 71% upside in the metal. So if the metal is going to pop by 30 to 70%, then the stocks themselves are going to probably end up doing multiples of 2 or 3 on top of that. On June the 9th, National Bank put out a piece that suggested that small and mid-cap Canadian gold stocks are trading at anywhere from 25 to 52% discounts compared to enterprise value to cash flow against historic peak levels. So again, we're happy to have the golds in the portfolio, but we're not in love. So there's a maximum of 3 stocks that can be in any of the 11 GICS subgroups. So at the moment, you would end up saying, okay, unfettered, the model would probably end up saying, gee, you should be owning 6 gold stocks. But historically, when we've done our back testing, it says, look, in any subgroup, the maximum you can own is basically 3 stocks. So, but there's no minimum that's required, so you can quite happily have no financial service stocks, and you can see in the portfolio, basically there's no banks and no insurance companies currently. On to the next stock or slide, please. Okay, one of the holdings that's in the portfolio recently added is Alimentation Couche-Tard. We have owned this stock in the past, and basically TD says they're expecting a blowout for the coming Q4 of fiscal 2020, and effectively they're saying that the gasoline margins will be huge. We like the stock because free cash flow over the last 12 months has been $2.6 billion. So when you end up saying, okay, if they want to buy something, obviously 2.6 allows them to do that quite easily. 4.6% free cash flow yield, which is a B- compared to the 700 stocks in the Morningstar database. They do have debt, but their ability to service debt's pretty good because their net debt to EBITDA is a mere 1.8 times, and they're doing quite well on their trailing ROE of 19.5%. So it goes back to the things that we're looking for: high free cash flow yield, low net debt, high ROE. On to the next stock, please. We talked previously about Franco, Nevada being a stock that we own in the portfolio. This is a chart from Tony Popovich, who is technical analyst at 1 of 2 at IA Securities. He basically says, look, we think the stock's obviously pulled back. Looks like it's going to turn around, and we basically have the potential to head back towards the old high of $215, which applies 24% potential upside. Again, we think there's great opportunity. If you look at the work of David Rosenberg and others, they end up saying, look, regardless of what the economy and or the markets throw at it, whether it's disinflation or inflation, Rosenberg says he thinks that gold is a good asset to have, and regardless of what the market throws at you. And again, in my view, because of the potential upside in the commodity and the free cash flow generations of the metals, I think it's a good place to be as well. Next slide, please. Okay, so we look for stocks that are basically less expensive than the market, less volatile in the market, allow you to sleep at night. That on top of the moves to cash when the system itself says, okay, you need to take a breather, again allows us to sleep at night. So the 15 stocks that are currently held in the portfolio on an equally weighted basis. As of last night's close, here's what it looks like. 1-year beta is basically about a 30% discount to the market. The debt to equity is 4 times less than that of the typical stock. The ability to service the debt is 5 times better than that of the typical company. The dividend yield is lower than that of the market, but this is a total return strategy they're looking for. And the latest year-over-year growth in dividends is about 47% better than the market, 9.4% typical increase in dividends by the stocks. Next slide, please. So these stocks are doing well. Their year-over-year sales growth in the most recent quarter reported is about 6% year-over-year. That compares to the typical stock of down 9%. So we end up saying, okay, obviously the markets have been impacted, but overall earnings have been not great for the market. Year-over-year cash flow in the 15 stocks is average up 19% compared to pretty much break even on actually minus 1% for the other stocks. Year-over-year earnings growth up 8% for the 15 stocks on average, down 48% versus the market. Year-over-year free cash flow growth absolutely huge, up over 200% compared to the market, about 5%. And what do you pay for all this amazing excellence? Enterprise value to sales, about a 40% discount compared to the market, 5.7 times compared to the market at 9.5. And enterprise value to EBITDA, almost a 60% discount compared to the market, 10.3x compared to 25 for the market. So overall, it's a strategy that holds up to 15 stocks, moves to cash when we're automatically, well, basically says, okay, conditions aren't right, and then effectively says, okay, it's time to move back in as well. Overall, the stocks do very well overall in the marketplace, particularly do well in the kind of conditions we're seeing today, and we think that there's a great opportunity for the strategy going forward. And on that note, we're open for questions and answers. Oh, my apologies. The other part is my next BNN market call. My last one was May the 29th. The upcoming one is Tuesday, June the 30th at 12 noon. So if you got any more detailed questions beyond what can't be answered today, there's another opportunity on BNN market call with me on, again, Tuesday, June the 30th, 12 noon. Q&A.
Thanks so much, Robert. That's right, indeed. We will be moving on now to the Q&A portion of the webinar. So if anybody has some questions for Robert, please feel free to use the Q&A section of the webinar to ask, and we'll be doing our best to get through as many as we possibly can. We do have a couple in here so far. So Robert, if you're ready, then we'll start.
Sure, we're good to go.
All right. So first things here, is there a particular sector that you're looking to buy during this pullback?
No, I'm typically agnostic with regard to sector, particularly in the small cap space. Obviously, we talked about golds earlier in the kind of larger cap companies. I think there's opportunities, but if you look at the kind of 3 stocks that we talked about, I used to manage money for a little old lady, and when I was running money at literally Dominion Securities Investment Management, way before the bank bought us, etc. And her, she had absolute glee when the market was pulling back because she went, oh, stock's on sale, I can end up buying more. And as I described earlier, a pullback is a great buying opportunity. The stocks that we hold, I think, offer great opportunities. As I said, we've got 30% cash. We're sitting there with a kind of blue buy ticket saying, okay, some of these stocks will pull back, which then will provide great opportunities, and hopefully there'll be kind of positive news, very much like Earth Alive, as we're expecting between now and the end of the calendar year, to kind of further provide upside in the stock.
Great. What are your thoughts on oil and gas for the long term?
Long side. Okay, so oil by itself, again, going back to Javed Mirza's portion of we're not particularly keen on commodities for the long term. And again, I think there's a huge transition. You even saw Sleepy Enbridge on the cover of Globe and Mail a couple of days ago saying, okay, we're trying to transition over towards renewable natural gas and other kind of projects. And there's a logic from an economic perspective to do that. So if you look at ZBEC, and they end up saying, okay, typical project that you look at Boralex or Northland Power in the kind of wind or solar area currently generates approximately a 7 to 9% return. The portions that ZBEC is looking at on their deal in the kind of renewable natural gas is that they can end up getting approximately $20 per MCF for natural gas versus the roughly $2 you get in the oil and gas patch. And as a result, they are looking at approximately 15% returns unlevered. And if you end up putting leverage on top of that, then you get about a 30% return. So I don't think there'd be any difficulty of owners, teachers, or anybody else saying, gee, ZBEC, if you'd like to have us lend you a bunch of money so we can participate in some of that 15+% IRRs we became. Turning back to natural gas, National Bank put out a piece about 2 weeks ago that I talked about on BNN, which effectively says because there is not a ton of oil being produced, then there isn't an awful lot of natural gas being captured as a byproduct. That may put us into a shortage of natural gas as we go into the winter heating season. If so, then the price of natural gas will go up significantly. It may provide a big opportunity. We own Tourmaline, oil and gas, mainly a gas company in the Canadian conservative growth strategy, which would be a beneficiary for that. But generally speaking, we think that, yes, oil will pick up a little bit, but when you end up looking at the kind of oil that can be produced at the fringe of the actual cost of production, I don't think you're going to see a huge amount of oil that basically is, I don't see oil going back to $90. Okay.
Gotcha. Next one here is, what small cap golds do you like?
Okay, so I've talked about some of them on BNN. One is particularly Teranga. My recollection of the symbol is Thomas George Zorro. Remember that they have a property in South Africa, and approximately 3 months ago, they acquired a property from Barrick Gold. The Teranga property itself produces 2 grams of ton of gold. The Barrick property is at least 3 grams, it's about 40 kilometers away, and it makes financial sense to throw the rock on a truck, haul it over to Teranga's property and crush it there. Teranga should end up producing a huge amount of free cash flow, and I think the number is like in excess of $200 million in 2021, and as a result, it's a favorite pick. Centerra Gold, symbol CG, is also a pick. One of the brokerage firms recently has said, okay, looks like it should be doing as well. And interestingly, a fallen angel in the kind of larger cap size, Kirkland Lake, now shows up on our work, and it's a candidate for purchase. So small gold companies, great leverage. We prefer the ones that are actually in production. Yes, you can make investments in companies that are doing the exploration stuff, but our preference, generally speaking, is free cash flow, and Teranga and Centerra Gold are two that fit the bill.
Right. Okay. Looking at some of the stocks that you highlighted in the presentation, it seems like you like waste management companies. And is there a reason for that? And do you own shares in Earthworks?
All right. The easy part is garbage is not going away. And unfortunately, if you look at the e-commerce industry, effectively, if you look and you say, gee, I used to go to Canadian Tire and buy something, now it becomes one of, gee, I have it delivered by Amazon. And it becomes one of, gee, there's a cardboard box, it's got a whole bunch of little puffy kind of plastic inside, and then there's the actual package that the box comes in that you normally would have at Canadian Tire. So in my view, the amount of packaging, if you will, per amount of GDP is rising and going to continue to grow. So unfortunately, as a result, plastic buybacks are key and a problem. So yes, I do own shares in Earthworks. EWK is the stock symbol. This is a company that I have owned and followed for a long time, and I mean 7 to 10 years. They're working on effectively the potential of having the first new garbage dump from recollection in 25 years. They're approximately 65 miles away from San Francisco, and the beauty is that, as I described, that if this was a mine and someone said to you, I'm going to basically have my first offtake agreement by the end of the calendar year, if you hear that in a mine, you get excited. So back when the stock was 10 cents, I participated in recent financing, put 50 grand to work. Stock's currently around 20 to 25 cents. And the beauty is that when they start to build out their facility, it isn't like a mine you got to come up with $250 million. This is a relatively modest amount of 25 to 30 million bucks to be able to build out the capacity on an ongoing basis. In addition, they basically said, this is not just going to be a simple hole in the ground, we're going to dump stuff. We'll end up looking at potential technologies like Cielo that can end up saying, Cielo's argument is, look, I can take all the stuff that normally goes into a garbage dump, run it through my process, and produce biodiesel from that. So if you sorted out just the plastic, could happily make money, etc. So we think there's a very long cycle opportunity in earthworks. The other part too is remember that there were the fires around in California within the last year, and a whole bunch of junk was basically hauled off to the dump. So a lot of the capacity where everybody said, no problem, we got a 20-year kind of mine life equivalent for hole in the ground to dump stuff in, that was dramatically shortened within the last couple of years as well. So earthworks, EWK, we think there's a great opportunity. And I understand that they're working with kind of one of Canada's top IR/PR firms that I was instrumental in recommending. Alias Investor Cube is on the case. And you will see, in my view, a more formal improvement in their website and a whole bunch of packaging to be able to have the world know that they believe that they'll end up having a lot of great news between now and the end of the calendar year. So yes, I do own approximately $50,000 worth of stock at 10 cents. I have owned it in the past as well. Earthworks, EWK.
Perfect. We're running towards the end here. So another one is, do you have any, in bracket, COVID stocks?
The answer is yes. So there's a bunch of them. So as an example, Cardiol, symbol CRDL, is basically a company that makes 100% pure synthetic CBD. So they basically have said 3 years ago, look, CBD works well to reduce inflammation in the lungs. And they basically have applied to end up saying, look, we can test this with COVID because COVID itself basically causes the problems with not only the infection, but it causes secondary infections. So you either get pneumonia and got lung problems, it ends up screwing up with your kidneys, and unfortunately dialysis is now in short supply because of that. So I own shares of Algernon, symbol ATN, participated in recent financing. Own shares of Arch, ARCH is the symbol, Arch Bio. They basically have Health Canada approval to do a similar kind of test of their product as well. They're expecting to do, or they have submitted to FDA, from recollection, they're expecting an FDA approval as a guess within approximately 2 to 4 weeks. So there's a bunch of companies that we own that are in the space. And again, it's a very speculative. The advantage of Algernon is they also have tests underway in Korea for COVID, but they also have tests underway in Australia for their chronic cough solution of a repurposed drug. The advantage is this company trades for approximately 35 million bucks. When you look at Bellus in comparison, Bellus's market cap with a chronic cough product, it has a market cap well in excess of 800 million bucks. And it's going to go, okay, I think those things should narrow over time.
Perfect. Well, thank you so much, Robert, for coming on and talking to us and sharing your expertise. I know everybody on the call really appreciates you taking the time and sharing your knowledge. So thank you so much for being with us today.
You're very welcome. Thanks for having me on.